Okay, we've been directed. Okay, this is our FR Premock 2025 exams. There you go. We've got it. Okay. The thing is, I have section A, all these questions to do. Section B, all these questions to do. But I'm moving on to section C. I'm going to start off with section C and then I'll come to section A and B. Okay. So this is your ACCA platform, my dear. Everybody, you're with me? You're with me, everybody? Everybody, you're with me? Everybody with me? Okay, superb. This is your ACCA platform. This is how your real ACCA exam will also look like. Okay, your real ACCA exam will also look like this, and then you will have your space here to answer. Are we clear? Are we clear? Okay, so we're going to do it together, but I'm not going to do it under exam timing. Okay, I'm going to explain and do it. But if you are looking at exam timing, I have already shared videos with you where I'm working on exam timing. Please watch it. Please watch it on exam timing on the real platform. I'm doing it in class. I can't do it under exam timing, but I will try to explain and do it. Okay. Superb. I want all of y'all. There's about 45. I want all of you to right away log into this. How did you unblock the pop-up window? Go to Safari settings or directly go to Chrome. In Chrome you can, or just Google how to unblock settings. Okay, I want all of you to log into this platform through your original ACCA account and give me a done. I want everybody to log into your ACCA login, your practice platform, and give me a done. I'm waiting for you. I'm giving you about 5 minutes. Okay, I'm giving you 5 minutes. I want all of you to log into it. I'll be back soon. Okay, shall we start? Requirement. Explain the discovery of the inventory defects. Explain how the discovery of inventory defects would affect the financial statements of Mervyn Co. for the 2018 financial year end. Explain how the discovery of inventory defects. 3 marks. So probably I think there is some inventory defect somewhere here. Okay, they want to know within the note there is a inventory defect. How will that affect? How will that affect the financial statement? So I have not read the question. No, I'm only reading the requirement in the exam. I have not read the question. So I'm going to just leave it like that. I'll come back. Okay. How can I go navigate? Okay, that's next. Prepare a schedule of adjustments to the draft profit list in the trial balance, taking into account the additional information notes 1 to 5. 1, 2, 3, 4. Sorry, 1 to 4. 1 to 4, they want me to take the profits and then work through the profits. Your examiner's one of the favorite requirements. Adjust the profits. Number 3, they want us to prepare the statement of financial position of Mervyn. 9 marks, 8 marks and 3 marks. So in total 20 marks for me in the exam for this requirement. This is the pre-mock exam. This is the pre-mock exam for September, and we are going to see how to do it. So your examiner wants you to prepare a schedule of adjustment in the exam. I'm going to take my schedule. Sorry? Part A we can do it later because we have not read the entire question. No. So schedule of adjustments. Okay, now I'm having problems with my, because I'm using an iPad, guys. Since I'm using an iPad, I'm having problems here working through this. I'm using an iPad, guys, so my iPad is not picking up the blank in the software. Okay, can I do it on Excel, because it's going to look the similar schedule is there on Excel. So can I do it on Excel? Okay, you can do it on the platform because you have your laptop. I'm using an iPad. You can use your laptops, no problem. Okay, so I'm gonna come back here. I'm gonna do it over here. Premock. Okay, this is how in the exam your real ACCA platform is going to look like. Okay, we know that. but I'm gonna do it here. Okay, it's a bit inconvenient for me, so let me take the full screen. Okay. Prepare a schedule of adjustments to the draft profit list in the trial balance. Okay, so I'm gonna say schedule of adjustments to profits. Schedule of adjustments to profits. What is the company name? Mervin. Guys, just give me a second. I'll change my keyboard. Okay, my keyboard is a bit annoying. I'll change it. Okay, schedule of adjustments for profits. Mervin. That's the name of the company, right? Okay, I've already taken it on top. Okay, now we have the question. Now in the exam we can read the question. Okay, let's go to the question. Okay. What is the question? Mervyn Co. has prepared a draft trial balance at 31st December 2018. What do you have? Property, plant and equipment carrying amount 36,000 and they have given us a note. Factory cost 7,500. Share capital 10,000. Revaluation reserve note 1,600. Retained earnings brought forward 1st of January 2018 55,740. Draft profit for the year ended 31st December 2018 4,500. Provisions for warranty 5,000. Dividends paid 7,240. Current tax payable 2,800. Inventories at 31st December 2018 8620. Trade receivables, cash, loan and trade payables. And then they have given us the following notes. And what is the requirement? Prepare a schedule of adjustments to draft profit listed in the trial balance. How much is the draft profit, my dear? Everybody. How much is the draft profit, my dear? Everybody. Everybody. How much is the draft profit? How much is the draft profit? Draft profit is 4,500. So you're going to take 4,500 and make adjustments to it. So draft profits prior to adjustments. How much is it? 4,500. And then you will have your adjustments in the exam. And then you will have your adjustments in the exam. And then you will get your corrected profits. Correct? And to do your adjustments, obviously you know there are workings. We will start doing the workings also. Are we clear? Are we clear? Super. Let's go to the question. Mervyn Co. has been constructing a second factory since 1st of January 2017. What's your year end? Your year end is 31st December 2018. Correct. On 31st August, meaning during the current year, on 31st August 2018, the construction of the factory was completed. During the year, they completed it. So, in January 2017, they started. 31st August 2018, they completed, meaning 1 year gone, 8 months gone, 1 year, 8 months gone. The construction of the factory was completed and at this date, it was ready for immediate use. It is ready for use. At 31st December 2017, that is last year, the carrying amount of the factory under construction was correctly calculated. The carrying amount of the cost of the factory has been correctly calculated. At how much? 8 million. The cost incurred in the current year, until last year it's done, the cost incurred in the current year were as follows. Material, labor and subcontractors 5,000, other directly attributable overhead cost 2,000, administrative overhead cost 500. All of the above cost has been recorded in the factory cost account in the above trial balance. In the above trial balance, 7,500 is already recorded. A specific loan of 18 million was obtained in 2017 to fund the construction of the factory. It carries an annual rate of interest at 10.5%. The loan was still outstanding at 31st December as at the year end. All interest on the loan has been recorded as an interest expense in the P&L for that period. M depreciates factory building over 20 years. No entries have been made in respect of the depreciation of the factory in the year ended 31st December 2018. Entirely it is note 1. So when you take note 1, they are testing you with multiple accounting standards. It's not just one accounting standard, they are testing you with multiple accounting standards. So here, Mervyn Co. has been constructing a second factory since 1st of January 2017. On 31st August 2018, the construction of the factory was completed and at this date it was ready for immediate use. At 31st December 2017, the carrying amount of the factory under construction was correctly calculated at 8 million. The cost in the current year was as follows. Okay, you had your last year value 8,000 and current year value which is 7,500, which is made up of material, labor and subcontractors, other directly attributable overhead costs and administrative overheads. And out of everything they say the 8,000 has been included correctly, so nothing to worry about the 8,000. 7,500 has been included this year as your factory cost. 7,500 cost here is correct or incorrect? Do you have any problem there? Incorrect. Brilliant, because there is admin overheads of 500. Admin overheads, assets are recognized at cost. IAS 16, assets are recognized at cost. Cost means all expenses incurred to bring an asset to its intended use. All the expenses are fine, but administrative overheads 500 cannot be included as a part of your assets cost, which is included. Now what you have to do is you have to remove it. So coming back, workings, working 1, IAS 16, assets recognized at cost. So all expenses incurred to bring an asset to its intended use can be capitalized. However, now you have taken admin expenses which cannot be taken as a part of a factory cost, which needs to be removed. Are we clear? Okay. So admin overheads cannot be included as factory cost. Therefore has to be removed. Are we clear?
So do we have to mention the standards?
You don't have to, has to be removed. Okay. Now Ziyan, you are giving notes like this. Should I include in the exam? No, you don't have to. You can directly go and say, hey, look, you can't include admin cost. Here, you have already included admin cost. So basically it should have gone to P&L. You are going to debit your P&L. You're going to debit your P&L how much? 500. It's included as a part of my factory cost. So credit factory cost. How much? 500. You can simply do that. I'm fine with that. No problem. In the exam you do that. I'm fine with that. No problem. So basically when you take my P&L, my cost should go up or come down? My cost should go up. My 500 which I should have taken to my P&L, now I have taken it to my cost of the asset. Now my cost should go up, meaning adjustment here. What is happening? I'm having admin overheads. Admin overheads. Why does it go up? Admin overheads. How much am I going to adjust?
500.
I'm going to adjust 500. I'm going to adjust 500, meaning this should go up or come down?
Up.
I am working with my profits. My cost is going down means my profit should come down. My cost, admin cost should go up means my profit should come down because I'm working with profits. Are we clear? My cost is going up. I'm debiting my P&L. If I'm debiting my P&L, my cost is going up, therefore my profit is going to come down. Got it, everyone? My profit is going to come down. So therefore minus 500. Understood? Understood? Everybody, you can work with me, no problem. You can work with me on your platform. I want you to work in the platform, not on Excel, but I'm working on Excel. Okay, understood? So, next. Oh, okay, I can. Okay. All the above cost has been recorded in the factory cost account in the trial balance. Okay, we have reduced the 500. A specific loan of 18 million was obtained in 2017 to fund the construction. Okay, to fund the construction, I'm borrowing standard. IAS 23 borrowing cost. Working 1 done. Working 2. Borrowing cost. Now what is happening? To fund the construction, I'm borrowing. How much am I borrowing? 18 million. Was obtained in 2017 to fund the construction of the factory, and it carries an annual rate of interest of 10.5%. The loan was still outstanding at 31st December 2018. All interest on the loan has been recorded as an interest expense in the P&L. What does IAS 23 say? IAS 23 says, yes, you are bringing an asset to its intended use. So you are particularly purchasing this loan, getting this loan to bring an asset to its intended use. Therefore, the interest, the finance cost on the loan can be capitalized until the asset is ready for use. When is the asset ready for use? The asset is ready for use in August. So Jan, Feb, March, April, May, June, July, August, for 8 months technically you can capitalize, but instead for the entire year they have expensed. They have already done the expense, but now what you should do, you should reverse it. So therefore your total borrowing cost will be 18,000 into 10.5%, that is for 1 year, am I right? But how much can you capitalize? You can capitalize for 8 months, correct? So into 8/12 can be capitalized. Therefore equals 18,000 into 10% into 8/12, which is 1000, 10.5%, I'm sorry, 10.5% into 8/12, which is 1260, can be capitalized. But I have already gone and expensed it. If I have expensed it, my profits are understated. My expenses are overstated, my profits are understated. Now I have to reverse it, meaning I have to credit my P&L. So I will credit my P&L and I will debit what? My factory. My factory will be debited, meaning my factory cost will go up.
So do we have to show this double entry?
Better.
So factory cost will go down.
I have not capitalized. Now I have to capitalize. This 1260 I have not capitalized. No, I have expensed. No.
Interest expense.
Yes.
So factory increases.
Of course, my factory increases. Are we clear, everybody, guys? Guys online, are we clear? Yes or no? Are we clear? Yes or no? So I'm going to go to the top. I'm going to come here. Okay. Now my profit should go up because I have expensed. Correct? So borrowing cost reversal. Correct? I'm reversing my cost. So how much is that? 1260. Now I need to add this. So I'm going to add it. Done. Understood? Let's go further. And number 3. Mervyn depreciates factory building over 20 years. No entries have been made in respect of the depreciation of the factory in the year ended 31st December 2018. So number 3, working number 3, W3, depreciation. My depreciation, how much will be my depreciation? Anybody depreciation? Guys, my dear, depreciation will be an adjustment in every exam session, okay? You will get depreciation, okay? Depreciation. This is the first time I am doing this question, so I do not know. I will not know. Spot on, I will not know. Anybody with depreciation? Anybody? Hello, this is your mock. This is your real ACCA mock.
So I get 830.
813.
So would you scroll down?
Hasna 352. Asim, how much? Rubini, Hajara.
Sir, year end is 31st December 2018.
Now tell me. Asim,
Sir, we
394. Zameen, 813.
so we capitalized for 4 months.
I don't know, you have to tell me. Think. For how long should you capitalize? Your asset was available to be used from September. So your depreciation will be applicable from when? So now how much? Now how much? So depreciation, factory. What is the cost of the factory? Your cost of the factory will be how much? 7,500 minus 500, which is 7,000. Plus you have borrowing cost. Correct? Which needs to be added. How much is that? 1,260. This is the cost of the factory. Yes or no? Yes or no? No. You have a cost already coming. This is only current year cost. You have your initial cost also. How much is the initial cost? Initial cost is 8,000.
But that's the carrying amount, right?
Yeah, so they are taking the total cost, right? You have to take only now it's completed, right?
Okay.
It's the cost, right? So the total cost only now you have completed the asset. Meaning in total plus your 8,000, meaning your total will be how much? 16,260. How many years? 20 years. Equals 16,260 over 20 years, which gives you 813. Some of you all, yes, got your 813. I saw some of you have got 813. That is partially correct. Because you're done in August means September, October, November, December, 4 over 12. Some of you, good job. Okay, some of you equals this over 12 into 4. Is this happening, man? So equals this over 12 into 4 gives you 271. Correct. So from the point of usage, September, October, November, December for 4 months. Are we clear, everyone? Are we clear, everyone? Look, you get caught. You get caught because you have not read the question properly. Debit depreciation, credit what? Accumulated depreciation. Debit depreciation and credit accumulated depreciation. So my profits should come down or go up. My profit should come down or go up. Come down. So I go to the top. I'll say depreciation equals minus, I come down, how much? 271. Understood? Yes or no? Understood? Yes or no? Okay. Only now the first adjustment is done. Only now the first adjustment is done. Now we are moving on to the second adjustment. Let's go to the second adjustment. The revaluation reserves relate to M's head office. Okay, where is revaluation? We saw revaluation 1600. So that relates to M's head office at 1st of December 2018. 1st of December 2018 means during the current year. Now just 1 month. Your year end is 31st December. At 1st of December 2019, during the current year, it was discovered that the head office had been damaged due to a storm, resulting in an impairment loss of 2 million. This has been included in the calculation of the draft profit before tax, and it is reflected in the carrying amount of the property, plant, in the calculation of the draft profit before tax, and is reflected in the carrying amount of the property, plant, and equipment. It is reflected. It is reflected. Depreciation on the head office has been calculated and recorded correctly. Depreciation in the head office has been calculated and recorded correctly, so you don't have to do anything. M does not make a transfer from revaluation surplus to retained earnings in relation to revalued assets. What is it? What is it? IS 36. Superb. What? Reversal of impairment. Reversal of impairment. Basically, what they have done, they have taken the impairment cost to the P&L. But technically, you have revaluation. The standard says for that particular asset, if there is revaluation, first go and set off against the revaluation. But what did you do? You went and took the entire amount to the retained earnings, meaning your rate and your profit has come down. The revaluation reserve relates to M's head office. At 1st December 2018, it was discovered that the head office had been damaged due to storm. They are saying directly this revaluation is relevant for head office. And there has been an impairment. So first, what should you do? If you have revaluation, the standard requires you to set off against your revaluation. But what did they do? They have directly taken it to retained earnings, meaning your retained, your profits are understated. But what is the maximum value can you set off? Can you set off 2 million? No, because here the maximum you can set off says only 1600. Because your revaluation is how much here? 1600, right? So maximum you can set off is only 1600. So out of this 2000, you can reverse 1600. Anything extra can take it to retained earnings, no problem. So next point, working number 4. Working number 4, reversal of impairment. So 1600 to be reversed, 1600 to be reversed from profits. Are we clear? Where do you take it? To revaluation reserve. So I'm gonna debit my revaluation reserve 1600. Credit what? Brilliant, credit P&L 1600. Meaning my profit is going to go up or come down now? Brilliant, my profit is going to go up. Impairment reversal 1600. Now I'm going to add it. Guys, everybody, are we clear? Guys, everybody, are we clear? Guys, everybody, are we clear? Got it? Got it? Got it? Yes or no? Everybody. Okay, let's go further. I mean, it can't get this easy, right? I mean, this is easy. This is not technical. This is easy. Very, very easy. Very easy. Compared to the questions that we have done in the past, you can't even compare. No, actual paper has to be easier than the mock if you are prepared. But aren't you all prepared? How long to go? 2 weeks to go.
12 days.
12 days. Today is the Saturday. Next Saturday, next Thursday. Okay, superb. So you know, right, we are meeting next Saturday, Sunday also. I'm meeting you tomorrow. I'm meeting you next Saturday and Sunday also. I'm meeting you next Saturday and Sunday also. Okay? Okay, superb. Mervyn estimates its provisions for warranties based on past experience. The provision for the current period has not yet been calculated or recognized. The information below has been compiled by management for the purpose of calculating the required provision at 31st December 2018. Standard. What is the standard? IS 30? IS 37. Okay, superb. Do the calculation for me. Tell me the calculation. IS 37. Do the calculation. Tell me the calculation. Do it.
Could we show the trial balance?
Could I show the trial balance? Yes, I can.
There's an increase in provision.
There's an increase in provision. Increase in provision of how much? Increase in provision of 1,060,000. Okay, provision brought forward. Okay, working number 5. Provisions IAS 37. Okay, now based on this, we can obviously provide for provision. Okay, brought forward provision is how much? 5,000. Current year, you have to calculate. Correct. So current year, let's do the calculation. Okay, what is happening in the current year? They say M estimates its provision for warranties based on past experience. The provision for the current period has not yet been calculated or recognized. The information below has been compiled by the management for the purpose of calculating the required provision. At 31st December 2018, product A, product B. So you have two products. So product A, product B. Product A, units sold 25,000. Product B, 1,100,000. Okay, superb. Probability 15%, 30%, 15% and 30%, and then expected cost is 32 and 18. 32 and 18. Therefore, equals this into this into this. 120,000 for product A, 5,940,000 for product B. Therefore, my total provision that I will have to provide has to be divided by 1000. I'm working to thousands, right? 6,060. So already 5,000 is provided. Already 5,000 is provided. So my carried forward will be 6,060, correct? So current year will be 6,060 minus 5,000, which is 1,060. Out of 6,060, 5,000 is already provided. There is an increase of 1,060. So debit provisions in the P&L and credit provisions liability in the balance sheet. Are we clear? So meaning my profits will go down or go up? Come down by how much? 1,060. provisions equals minus 1060. Come on, it can't get easier than this. It's obviously easy, right? Very, very easy. In February 2019, prior to the financial statements being authorized for issue, before financial statements are authorized for issue, Mervyn determined that some of its inventory produced in December 2018 had manufacturing defaults. Taking this into account, the NRV of the total inventory at 31st December 18 was determined to be 6 million. None of the damaged inventory had been sold. Okay, there have been inventory which is damaged. They said the NRV is 6,000. The cost is given here as 8,620. So inventory valuation, what do you have? You have an impairment. Inventory impairment. Cost of the inventory, and you have been given NRV. Now my dear, when is this happening? Prior to the financial year. Because this is happening prior to the financial year, actually this is happening in February 2019, your year end is 31st December 2018, but does this provide evidence of conditions existing as at the reporting date?
Yes. Yes.
Is it an adjusting item or non-adjusting event? Adjusting event, because as at the year end there is evidence of conditions existing as at the reporting date, so it becomes an adjusting event. This is the part A your examiner wanted answer for. Part A, your examiner wanted to talk to you about explain. There was an explanation area, and that explanation was this. Are you clear?
So in case if that was after financial statements, then we don't adjust.
No, you can't. Then it becomes an error.
Error.
Opening retained earnings should go and adjust it.
Next year opening.
And you bring down, there is impairment. There is impairment. So right now, you can go and adjust your current year financial statements. So current year financial statements, you are going to bring down by how much? 6,000 is here. NRV is 6,000. Your cost is going to be how much? Your cost they have given you, inventories is 8,620. Your 8,620 and 6,000. 6,000. Therefore, you have this minus this. 2,620 is your impairment of inventory to be written down. So how will you write down? You will debit your P&L, debit P&L, credit inventory equals 2620, meaning your inventory value, your profit will come down or go up. Your profits are going to come down. So therefore you have inventory write-off equals minus 2,620. Therefore, our adjusted profits, would be equals sum 2,909 adjusted profits.
So could you show the note 4 again?
Yeah, I will. Are we clear, everyone? Are we clear, everyone? Are we clear, everyone?
And the inventory also.
Are we clear, everyone? Understood? Everybody understood? Clear?
So now it's early, no? What's the problem is there's a power cut in our house, so I could charge the phone.
Yeah, that's okay.
So battery load is there.
No problem. That is important. Phone is important. Don't worry, it's okay. Take it easy. Take it easy. Okay. So guys, we have entirely completed the schedule of adjustments. Okay. We have entirely completed the schedule of adjustments. That is done. Because Hasna, they say they have entirely calculated the 8,000 properly. So there's no problem there. They say entire 8,000 here. The carrying amount of the factory under construction was correctly calculated at 8,000, meaning they have entirely done that adjustment correctly. You don't have to worry about it. Okay. Now the requirement: prepare the statement of financial position of Mervyn at 31st December 2018. Okay, they are requesting us to prepare the statement of financial position. So we are going to prepare the statement of financial position. Okay, it's not a big area, right? It's a relatively small area. You want to try it? You want to start doing it on your own? Prepare the statement of financial position. You want to do it on your own? Statement of financial position. I'll give you about let's say okay. How many marks is this? Okay, let's try 9 marks. How many minutes can you take in the exam? 9 into 1.8. Okay, 9 into 1.8. About 16 minutes you can take. I'll give you about 16-17 minutes. Okay, I want to see if you can how you can do it on your own. Okay, take your 16 minutes. Your time starts now. I want you to see if you can do it.
So, is there like any specific format for this as well? Like
No. You can just do your normal format. While doing this, you got to make sure that you take account. Of all your adjustments as well, whatever we've made. Okay, start now. Okay, let's start. Balanced. Okay. Okay, let's quickly start. Let's finish this off. And then schedule of adjustments for profits is done, and now we're going to do the statement of financial position. Okay, so we can say Mervyn's statement of financial position as at 31st December 2018. Are we clear? So we have assets, non-current assets. Okay, what are the non-current assets we have? We have property, plant and equipment, and then factory also. So we have property, plant and equipment. If you want, you can take everything together, no problem, or you can show factory separately. And they say property, plant and equipment already includes the factory, no, which is 8,000. So directly what you can do is you can take your property, plant and equipment amount, which is 36,000, equals 36,000. So forget about factory, property, plant and equipment plus your factory. your factory is, your total factory is
7,000 plus 1,260.
initial cost out because it's taken 7,000 plus 1,260 minus 271, 43,989. That's your property, plant and equipment. Done. What's next? You can take your current assets.
So the 500
What is the 500?
we removed from admin.
Hmm?
We removed 500. That was the admin expense.
So we removed it here. No? We only took 7,000. No? We didn't take 7,500. No? Clear? Current assets. Inventory. Current assets inventory. How much is the inventory? We made some adjustments. Our net inventory was 6,000. Correct? Inventory done. After that, what do we have? Trade receivables is also there and cash is also there. So we have trade receivables. How much is the trade receivables? 11,020, no adjustments made, equals 11,020, no adjustments made, and then I have got cash. How much is cash? 33,030 equals 33,030, no adjustments made. Therefore, my total current assets equals sum 50/50. Therefore, my total assets would be 50/50 plus 43,989, 94,039. Clear? And then I have my equity. I have my equity. Under my equity, what do I have? Share capital. My share capital is at 10,000, no adjustments, right? Equals equals 10,000. Do I have share premium? No. I have retained earnings. So retained earnings are how much? Retained earnings. Okay, what do we have? We have dividends paid. We have dividends paid, and then we have retained earnings brought forward 55,740 and draft profit. So draft profit is wrong, we adjusted it. So retained earnings brought forward 55,740. So retained earnings brought forward 55,740. Current year profits. How much is my current year profits? 2909. And then dividends paid. How much is dividends paid? 7240. Minus 7240. This has to be a working, okay, below. It has to be a working, okay. Working number 7. Retained earnings. Therefore, your closing retained earnings would be $51,409. Therefore, retained earnings equals 51,409, And then what do we have? Revaluation reserve. But our revaluation reserve has exhausted. We entirely used it. So it becomes 0. Therefore, $61,409 is my total equity. And then what do I have? Non-current liabilities. Under non-current liabilities, what do I have? I have my loan. Loan directly 890. And then I have my provisions, warranty provisions. When am I supposed to pay? Next year. Yeah, current liability. Was it for some decommissioning cost? What? Okay. 31st December. Okay. Current liability, provisions. So, only loan, is it? No deferred tax, nothing, right?
Trade payables.
Hmm?
Of non-current liability will be low.
Mm-hmm. Then you have trade payables. I saw not oatcakes, it's payables. And then I saw tax payables as well, correct?
Yes.
Okay, trade payables is given as no adjustments, right?
No.
3880. And then tax payable is
2,800.
2,800, and then we have warranty provisions, which is 6,000. 6060. Anything else? That's it. So therefore I can take my total current liabilities. Therefore, $12,740. Total equity and liabilities would be equals 12,740 plus 19,890 plus 61,049, 94,039. Your question is balancing. Answer is balancing.
Sir, I have a small doubt. Sir, now usually we won't allow the overall cost.
Mm-hmm.
So overall cost is like we create a provision for something we replace in the future, like for a part of a. So something. So if the question says they have created a provision something like that and haven't specified.
You do not know overall cost when you will incur it. Here you know exactly the cost that you are going to incur. There is an obligation.
So if the question says they are creating a provision to replace a part like this, we recognize it, even though they.
Provided there is an obligation, a contractual or constructive obligation. Only if there is a contractual or constructive obligation, you can recognize it. If not, you can't recognize it.
So now let's say the part is 10,000. They are supposed to replace it in 5 years. So they provide 2,000 each year. Is it possible?
Then no. You have to wait until the obligation arises.
So they can't provide a provision of 2,000.
Done? Are we clear? See, it's a straightforward question. It did not even take us about 10 minutes to balance. In the exam, you have about 16 minutes to balance this. Okay, having said that, we have part A to do, correct? Part section C, we have done first, second and third requirement. We have the first requirement. Explain how the discovery of inventory defects would affect the financial statements of Mervyn Co. Okay, superb. Explain how the discovery of inventory defects would affect the financial statements of Mervyn Co. 3 marks in the exam. 3 marks, 3 points. First, they want to know how the discovery of the inventory would affect the financial statements of MCO for 2018 financial year end. They want to know for 2018 financial year end, how will this be affected? Okay, how are you going to answer? What are your 3 points? You have to plan your 3 points. Okay, now go back. What is the issue? What is happening? What is happening? In February 2019, prior to the financial statements being authorized for issue, MCO determined that some of its inventory produced in December 2018 had manufacturing defaults. Taking this into account, the NRV of the total inventory at 31st December 18 was determined to be 6 million. None of the damaged inventory had been sold. What is the impact?
The overall profits will fall.
Yeah, so they want to know what? They want to know, explain how the discovery of the inventory defects would affect the financial statements. Because you discovered what would happen. You have to give 3 points to get your 3 marks. Number 1, you have to tell the examiner if the inventory valuation will fall down or not. Number 2, yes, it is happening before the financial statements are issued to the shareholders. So you are going to talk about adjusting and non-adjusting event, and how that will have an impact in the financial statements. Are we clear? Are we clear? Shall we answer? Can we answer? 3 points. So part A. Okay. Inventory belonging to the 2018 year had manufacturing year had manufacturing defects which were only identified post year end. Correct? Which were only identified post year end. However, this provides evidence of conditions existing at the reporting period. Therefore, in line with IAS 10, this will need to be adjusted. That is number 1. I spoke about adjustments. You understand my point? Number 2. If the adjustments are made, inventory valuation currently carried in the financials will change. As a result, inventory will come down by how much? So you already have 8,620. Now it's 6,000. As a result, inventory will be written off by 2,620 and carried at how much? 6,000. Refer working, that was our working 6. You understand my point? That's the reason why I am making a change there. Are we clear? Do you understand why I'm trying to do it last? Because I can always go back and tell the examiner, look, you can go and check my working. Number 3. Overall, the profits will come down and inventory will come down by 2,620, and a disclosure of this has to be made in the financial statements. Understood? So that's my first, second and third point. My 3 points to get my 3 marks in the exam. Are we clear? Everybody, are we clear? Understood? Yes or no? Everybody? Okay, so with that we have completed mock section C first question. Now we have section C next question. Okay, so we have obviously a ratio, a company analysis question, a ratio analysis question. Not the first time we are looking at a ratio analysis question. We've been looking at this in the past also. Yes, but what I want you to do is, I'll be doing this question tomorrow. Okay, shall we start, everyone? Hello, everyone. Good afternoon. And we are starting off with the pre-mock September 2025 for the September mocks that is released by ACCA. Okay, having said that, we have completed a part of it, section C. I remember completing the question by the name Mervin. Mervin is entirely done. Now we are going to move on and look at the rest of the question that we have. And as you know, the platform is very, very, very slow. So you will have to give me some time. There's error. So even I can't access. I know that it's very, very, very slow. I'm struggling to access, unless otherwise someone has taken screenshots. No, it's not working. You have screenshots. Okay. Huh? No, Rish. What did we finish?
We have finished one.
Mervin was ratio, right? No. Okay. Do you have screenshots? Oh, okay. Okay. At least share that. No, we can't just be wasting time, right? I mean, it's not working. But your real ACC exams, this is not going to be the problem anyway. Okay, that's a solid this thing. So, but you need to also understand the amount of students accessing the website. The volume has to be very, very, very high. So could be that also. Okay, I've got the screenshot. So I'm gonna directly take the screenshots and start working on it. Okay. So I hope that's fine by everyone. That's the only way out. Give me a second. I'm just getting the screenshots. Do we have it in a nice way? Yeah. In a way where I can, it's easy for me to say. Because this is the first time I'm also doing these questions. It has to be smooth. Don't you have it in a PDF format? Does anyone have it in a nice, easy format? Yeah, you can send me the photos, but I want it in a way where, it's like Kaplan, like how they have given, it's easier for me to view it. Because even if I make a mistake, because for me, other questions, I know the questions. Here, since I'm doing it, I'm not too sure because if I don't get the correct look of it. I don't know if it will work. Sorry guys, this is killing a lot of our time. It's working for me now. Okay. No, for me it's the same problem. Okay. Let me try through my machine at least. Okay, so I have it in my screen. Do you all have it on your screen? But having said that, it's a problem for our recording because our recording doesn't have it. But can I take screenshots from my screen? Okay. One last time, if it doesn't work here, then I'm going to go to my laptop. Now I just sent it as PDF. Naresh, requirement is not there. No? They have the requirement also. But in the meantime, since Naresh is sending me that, someone else, can you start taking the section A, section B for me, please? At least. Screenshot, okay. A, B, C, D, E, F, G, December. What time is this? Okay, I've got this. Fine. What's the next thing? They have sent me the entire this thing, is it? Okay, at least this. At least this would do, yeah. But I'm just worried after finishing this. Okay, this is fine. How will we go to section A and B? That's my biggest problem. At least this is fine, let's say. We can somehow get it. I think I'm okay with this. Okay, new. There you go. Okay, ABC is there. So yeah, this helps me. Okay, let me use good notes. Okay, there you go. Okay, something better. Something. Thanks. Okay, thanks, Asim. I've got section A entirely from DM. Section A and section B, if you can send it to me, it's better. It's going to help me. Superb. Okay. Explain how contingent liability of MCO should be accounted for by ByteCo on 1st of January 2018. Okay, the requirement says explain how the contingent liability of MCO should be accounted by ByteCo on 1st of January 2018. Okay, I think there is a group. They are a group. So basically they are asking you, in the group, you have a subsidiary probably, and you have the parent Byte. Byte acquires probably M. I have not read the question. They want to know on 1st of January 2018, how should they account for the contingent liability? Okay. Now, basically, even before reading the scenario, I know when you take contingent liability is generally not recognized. Why? Because the conditions are not satisfied. However, IFRS 3 overrides and says, hey, look, even if the conditions are not satisfied, you have to recognize it. IFRS 3 business combination device says, hey, fine, I know the conditions are not satisfied, but that is in line with IAS 37. For the group, when you are going to recognize, you have to recognize. So technically, contingent liability will be taken as a part of your goodwill. If it is taken as a part of your goodwill, it will reduce your net assets, because it's a negative figure. It will reduce your net assets. So your goodwill will go up. How many marks in total? 3 marks, is it? Okay. I'm getting to know that this is for 3 marks, so I'm going to make it 3 marks. So I'm going to give 3 points in the exam. Okay. Number 2, calculate the following ratios for the year ended 31st December 2018 and 31st December 2017 for the Byte Group and ByteCo respectively. Gross profit margin, operating profit margin, and return on capital employed. Okay, they want 3 ratios: GPM, OPM, and ROCE. How many marks there? Once again 3. Oh wow, really? So for the committing, we are getting 14 marks. Okay, so you see your examiner is slowly moving towards the commenting part of it, which is going to be for 14 marks is what is known so far. So therefore, we have quite a lot of work to be done. So GPM, OPM, and ROCE is not something that is new to us. We have looked at in the past, and we will start answering the way we normally do. Okay, now in the exam, we are going to read the scenario. Now we know the requirement. and we are going to read the scenario, and then we are going to start getting the ratios and putting our comments in between, building our points. That's how we do it. We know that. Okay, super. Now we can start reading the question. We can start reading the question together. B, a prominent food manufacturing company specializing in pre-packed meals. Okay. B is a prominent food manufacturing company which specializes in pre-packed meals. Pre-packed meals. Okay. Purchased an 80% shareholding in MCO on 1st of January 2018. Okay. So they purchased on 1st of January 2018. Your last year, you have a single entity statement. This year, it's consolidated. They directly say that. We have looked into a scenario like this before. Fatima. Habin acquired Fatima. From 2007, we looked at a question. See, after about 18 years now, I told you last week only, hey, look, I'm doing this particular question because I think something like this may come. Now, you see Premock, I never saw the Premock, it is there. So, going back, M, its sole subsidiary focuses exclusively on organic pre-packed meals. Okay, now from pre-packed meals, our subsidiary is focusing on organic meals, organic sources, organic sourcing. Now, when you take eggs, right, when you take eggs, you have normal eggs and you have eggs without cholesterol. Now, Arogya eggs is eggs without cholesterol. In India also, I think they have. So when you try to remove certain things from unhealthy things from a meal, or when you try to source it organically, the cost is normally high or low. The cost is normally high. So organically, if you are going to work on pre-packed meals, normally the cost is normally high. But yes, people are liking it. There is a shift. So we need to keep that in mind. This acquisition was strategic. They say, okay, it was a well-planned acquisition, reflecting the growing consumer demand for food from organic sources. Okay, so people are moving, like how we are moving to eco-friendly products, how we are moving to green energy, how we are moving from petrol-powered vehicles to electric-powered vehicles, battery-powered vehicles, solar energy. Like that, yes, there is a demand in organic foods as well, organic sources of foods as well. Extracts from Bright Group's consolidated financial statements for the year ended 31st December 2018 and Byte's individual financial statements for the year ended 31st December 2017 are provided. They say, okay, they are directly telling you, okay, look, there is consolidated and individual financial statements. Okay, what is happening? Revenue is going up. I can see revenue going up. Cost of sales is also going up. Obviously, if you take this financials, this includes a Byte and Munch together. Okay, so it includes Byte and Munch together. So obviously, Byte's Munch contribution is there in revenue. Cost of sales also will have it. GP, yes, it's going up. Operating expenses are going up. Operating profit is reducing. Operating profit is reducing. Profit before financing and income tax is also reducing, meaning there is nothing, they have not given us enough information there. Statement of financial statements, they've given us the extract, share capital, revaluation, retained earnings, and there is borrowing. So our retained earnings is going up, so probably that is consolidated retained earnings. Revaluation is also coming in. And then we have borrowed, probably I do not know, because in the last question they borrowed to acquire Fatima. If you remember right, they went for a loan note. Okay, I do not know. On 1st of January 2018, when you started, the carrying amounts of all MCO's assets and liabilities were equal to their fair values. Okay, fine. Before coming here in the exam, I have information to do my ratios. So it's better to do the ratios, and based on the ratios, we know what has happened so that we can give our comments accordingly. Okay, so let's start doing the ratios. I'm sure by now you would have done the ratios because we spoke about it. If you have not done the ratios, I'm giving you about 5 minutes to do the ratios on your own. Okay, I'm giving you about 5 minutes to do the ratios on your own, but that's a bit too much, honestly speaking. But that's okay. I'm going to give you about 5 minutes to do your ratios. Okay, you can start off, you can start off, you can start off. So your examiner wants you to calculate gross profit margin, operating profit margin, ROCE. That's it. Oh wow, okay. 2017 and 2018 both, and then you have your comment section. Anybody, your 2017 and 2018 figures, please, for me. Okay, I told you 5 minutes. Okay, I'm not done. Okay, you can take your 5 minutes. Okay, there you go. Done, 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 done. Anybody with answers? Anybody with answers? Anybody with answers? I need my gross profit margin for 2017 and 2018. For 2017, my GP margin will be 51,991 equals 51,991 over my revenue. My revenue is 160,000. 160,000, that is 32.4%. Correct? 32.4%. Number two, for 2018, my GP margin is 60,000 over 220,000 equals 60,000 over 220,000, which is 27.27%. Okay, I can see there is a drop in my GP margin from 2017 to 2018. My operating profit margin 31,746 equals 31,746 over 160,000, which gives you 19.8% in 2017. Correct? And in 2018, 25,000 over 220,000 over 220,000, which gives you 11.36%. ROCE, your ROCE is your operating profit over your your operating profit over your capital employed. Your ROCE will be in 2017 31,746 equals 31,746 over open brackets your equity 95,679 95,679 plus your non-current liability, which is 3,000, which gives you 0.3217 or 32%. Correct? Correct? And then 2018 you have 25,000 over 117,929 plus 8,000. Correct? Equals 25,000 over 117,929 plus 8,000. 19.8%. Okay. There you go. 19.8%. Okay. Are we clear? Guys, everybody, are you getting these figures? Everybody, are you getting these figures? My figures are correct. Are my figures correct? Correct? Is my figures correct? Correct? Super. Now, there you go. I have got my 3 marks in the exam. I've only got my 3 marks in the exam. Okay? Right. Revenue in the current year has gone down. Obviously, as I see itself, I know my GP margin. I'm going to talk about my GP margin. My revenue in the current year has gone down. That is an obvious fact. Okay? Revenue in the current year is gone down. I know that. Obviously, I know that. That's an obvious fact. What is the obvious fact? Revenue has gone down. Sorry, revenue has gone up. I'm sorry. Revenue has gone up. The current year has gone up. I'm sorry. My GP margin has also gone up. My GP margin has gone up. My revenue has also gone up. Wait. 2017-18. Okay. Oh, why am I confusing? This is my 2017. This is my 2018. Okay. My GP margin has gone down from 2017 to 2018. My GP margin has gone down. My revenue has gone. Now, in the exam, I know my 2018 figures is consolidated figures. 2017 figures is individual figures. Now, I have to bring that to the exam. Correct. So, the first thing that I'm going to do is, hey, look, my revenue has gone up. Correct. My revenue has gone up. My GP margin has come down. I know that. But my current year revenue is consolidated revenue. Okay. Super. I can say revenue has increased in the current year compared to 2017. Am I clear? However, current year revenue is consolidated, and last year the name of the company is B. Last year B was a single entity. Am I clear? So I'm just bringing in my points. Maybe I'll add something in between also as I read entirely. But you know, that is one point that I can of course talk about easily. That is one point, of course, that I can talk about easily without a problem. Are we clear, everyone? Yes or no? Are we clear, everyone? Yes or no? Okay. My revenue is going up. I know. My GP margin is coming down. There's a decrease in my GP margin. My revenue going up. My GP margin coming down. Okay. Well, okay, fine. Let's go back to notes. Let's try to understand what do the notes say. On 1st of January 2018, the carrying amounts of all M's assets and liabilities were equal to their fair values. The company had disclosed a contingent liability related to ongoing litigation concerning a food poisoning case. Okay, there is a food poisoning case. Okay. In its financial statement for the year ended 31st December 2017, this has had a fair value of 250 at 1st of January 2019. On 1st of October 2019, the case was settled at an amount of 310,000. Okay, so there is a problem. Now, in your current year, this 310,000 is an amount that you are paying. Correct? Yes or no? Where will that have an impact within my ratios? Which part of my ratios will be affected? Which part of my ratio will be affected? My operating expenses is affected. My operating profit margin is affected. Correct. My operating profit margin is affected. So, as I read itself, I'm building my points. So, there is a litigation charge paid this year. This would obviously reduce my operating profits. Correct. Now, we could also see that our operating profit has come down. Our operating profit has come down. So, probably this has made an impact. So, litigation charge paid this year has made an impact in our operating profit margin. But my dear, you need to keep that in mind. You need to keep something in mind. Now, this is going to happen every year, or is this one-off? It's one-off. Okay, now I will build my point with that. Okay, I will build my points. I'm taking my points. I'm trying to build my points. With my points, I'm gonna build my sentence. Okay. So, litigation charge paid this year. Okay. Now, I know my operating profit margin and my operating profits are coming down. Correct. So, I can obviously say operating profit margin has dropped in the current year. Litigation charge paid this year could have contributed to this. Correct. Are we clear? This is a one-off cost. So probably this will not be appearing next year. However, this is a one-off cost and this may not be seen next year. So I'm saying, hey, look, there is a problem. Yes, my operating profit margin has dropped in the current year. Yes, this could be due to number one, litigation charge paid this year. But this may not come next year. But I have a problem there. I have another problem. There you go. Ashfa says, Ziyan, look. This could affect the company's reputation. So provided this is not being spread among other people, there could be a slight risk of our products not being purchased. So I could also go on to say, as a part of my further information, additional information, and I need a conclusion. Correct? Additional information and there is a conclusion. Based on the conclusion, what is happening? I need further information about the litigation if the customers, if this is being spread among other customers and if my complaint levels are increasing. More information required on the litigation, and if there were any any further complaints resulting in negative customer goodwill. Okay, this is one thing that I need further information. As a part of my further information, I would want to understand, okay, if there are any problems that is happening. Good one, Ashwa, I'm with you. Superb. That looks superb. I'm happy. Let's go further. So I know about this litigation, and I know I have to talk about this litigation on top. Section part A. Okay. I know that. I'm coming there. Okay. M's individual financial statements for the year ended 31st December 2018 reflected revenue of 50 million. Okay. They say M's individual revenue was 50 million. Meaning your consolidated revenue is 220,000. So from 220,000, if you remove your 50 million, exactly. So they say M's individual financial statement, that is our subsidiaries contribution towards this 220 is 50 million. So that means B's revenue would be 220 minus 50, which is going to be 100. 220 minus 50 is 170 million. 170 million, 160 million, still yes, there is an increase, which is agreed. There is an increase. So B individually there is an increase in revenue. Okay. Revenue has increased in the current year compared to however current year revenue is consolidated. Last year B was a single entity. Further, after removing M's revenue of 50 million, B bite, which is B is still B's revenue has grown compared to last year. You understand? Still there is an increase in revenue. So we are saying, hey, look, there is an increase in revenue anyway. But if it has resulted in a drop in revenue, you're going to say, hey, look, if you remove it, like how we did it with Harbin. If you remove it, look, there is a drop in revenue. Then there's a problem. Are we clear? Super. That's the reason why they have given us, meaning to talk about that point. So we have a good point to talk about there. Now in the exam, I know, okay, fine, I've got 2 points. I need entirely 14 marks in the exam. So I'm going to make sure that my conclusion and my further information gives me about 2 to 3 points. And then I need about 10 to 11 points here. That's my objective in the exam. Let's go further. M currently focuses exclusively on manufacturing prepared meals. M is our subsidiary, correct? But it plans to expand its product range in the future to include cold pressed juices, food supplements, baby purees, and vegan meals. Okay, they want to expand their product lines. Okay. This decision comes as the organic food industry has become highly competitive. So we are in a highly competitive industry. If you are in a highly competitive industry, do I have price monopoly or not? Do I have price? Can I set the prices, or my prices cannot be set by me? Cannot be set. For example, if I am the only ACCA institute in Sri Lanka, I can set any prices that I want. If I have about 40-50 competitors among me, my prices have to be worked accordingly, correct? So I have price competition. Yes or no? I have price competition. So meaning my revenue can get affected. So going forward, where will that have an impact? Sorry? Where can my profits, my revenue be affected? gross profit margin. So basically, although I have a new market, we have got into a new market, but this new market is a very competitive market. Are we clear? Organic food industry is highly competitive. Although there is a market, it appears there is price competition. It appears there's price competition. So if there is price competition, my revenue, my prices will be obviously affected. So since it's highly competitive, my pricing could be affected. Therefore, my revenue can fall. Therefore, pricing could be competitive, leading to fall in revenue or narrow profit margins. Now see, I've got my second point also sorted. Are we clear? Yes or no? But for that, they have an alternative. What is the alternative? They say they are introducing more products. So still there could be more food coming in, varieties of food coming in, leading to probably higher revenue in the future. So there can be price competition. But since we are expanding our products, we are diversifying with our products, this could be compensated. Correct? Number 3. M is in the process of introducing more product. Where is that? More product ranges. Correct? And these are highly profitable. Therefore, revenue and profit margin can increase in the long run. M is in the process of introducing more product ranges, and these are highly profitable. Therefore, revenue and profit margin can increase in the long run. So it's a potential market. So this appears to be a potential market. Are we clear? Understood? Are we clear? How many points I've given? 1, 2, 3, 4. I've given 4 points so far. Okay. So higher profit margins, you're expecting higher profit margin. In 2018 financial year, MCO incurred substantial research costs related to its strategy for expanding its product line and invested significantly in marketing its existing offerings. Okay. So you're investing, there's a lot of research cost and there is a lot of marketing expenses. Research and marketing expenses, what will it affect? Operating expenses. So our operating profits to go down. Another reason could be our investments in research and then marketing expenses. Are we clear? Yes or no? B Group has invested significantly in research and marketing as they are launching new products. Now these are going to generate high income in the future, but in the short run it's squeezing my operating profits. In the short run, these have resulted in operating profits being affected. However, with these products having high demand, high demand, having high demand, profit margin and revenue can grow in the future or long run. So B group has invested significantly in research and marketing as they have launched new products. Guys, as they are launching new products, you don't have to worry about the spelling errors, okay? That's fine. Your examiner understands you have put launching there, no problem. Launching new products. In the short run, these have resulted in operating profits being affected. However, with these products having high demand, profit margin and revenue can grow in the future. How many points? 2, 3, 5 points. Okay. Okay, super. So this is number 2, this is number 1. Okay, I think I have to come reverse. Okay, fine. It's okay. Something is better than nothing. You've done a good job, mate. Okay, there you go. Everybody with me? Everybody with me? Everybody with me? Everybody with me? Yes or no? Can I get a yes? Okay, let's start. Indicating by clicking on the relevant boxes. Now, you know section A, you can be tested with multiple accounting standards. Section A is for 15 questions. You get 15 questions in section A. Section B also you will get how many questions? You have 5 questions from each and every standard, but you can get multiple standards. Okay. Indicating by clicking the relevant boxes whether the following statements describing advantages/disadvantages of IFRS accounting standards are correct or incorrect. Okay, IFRS accounting standards, we've been entirely soaked with accounting standards, yeah, entirely. So we know standards are issued by IASB, International Accounting Standards Board, and you have IFRS accounting standards. Improve comparability because they must be used by all listed companies worldwide. Okay, I want you to give me a quick answer. CI. Okay, number 1, C or I? Used by all listed companies worldwide. Listed by all listed companies worldwide. Okay, now there's another problem. Don't send me personal messages because it's a bit tough for me to come back here. Just send it in the group. Okay, so it's easier for me. IFRS standards, not all listed companies, each and every country have their own, there are inbuilt standards by the company. So it's not by all, but you can use it, right? But it's not all, so that is incorrect. IFRS accounting standards facilitates cross-border investments, correct? That's one of the purpose of IFRS accounting standards. IFRS accounting standards are suitable for reporting sizes of any size and type. No, it's not for any size and type, because if it's small, it's going to be a bit tough for you. IFRS accounting standards may be costly to implement. Yes, it is costly to implement because it's not easy. Incorrect. IASB follows standard setting process. IASB follows standard setting process when developing a new standard. What is the correct order of this standard setting process? Standard setting process order. Now I have in the exam for these 2 marks. For a mark I get how many minutes? 1.8 minutes. Now for this, now you see, I did not even take 30 seconds. Quick. These are theory. I know it's quick. Here once again, I won't take much time, but I will give my time to see, okay, what is happening. Okay. So they want to know, arrange the tokens below in order from step 1 to 4 of the process. Okay. Conduct a post implementation review. Conduct a post implementation review. After you implement, you're doing a review. Issue a discussion paper if relevant. Issue an exposure draft. Consultation with IFRS Advisory Council about adding the topic to the IASB's work plan. Consultation, adding a work plan is going to be the first. So you're going to do number one. That's going to be the first thing that is going to happen. You're going to consult if you require an accounting standard. Number two, once you think, okay, fine, you have an accounting standard, you need an accounting standard, it has to be discussed. So that's where the discussion paper comes in. Number three, exposure draft is before finalizing, we issue an exposure draft to the public. Number three, and then a post implementation review. Number four. So 1, 2, 3, 4, 1, 2, 3, and 4. That's how you have to probably drag and drop. Are we clear? Which two of the following criteria must be met for an asset to be recognized in the financial statements according to conceptual framework for financial reporting? Okay, obviously by now you know, for conceptual framework for elements, any elements, obviously you need to have faithful representation and relevance. Faithful representation and relevance is the key criteria for you in order to recognize the financial elements in the financial statements. Okay, faithful representation. Do we have? Okay, there you go. Recognition of the asset provides faithful representation. Number 4, and then verifiability out, reliability out, relevance. It has to be relevant, so it has to be 2. So it cannot be 1 in the exam. You can't tick 1. You have to tick 2 in the exam. So it's going to be this and this in the exam. Okay. See, I'm not taking much time. Greek code. Okay, requirement. What amount should the building be measured in Greek code statement of financial position at 31st December 2018? Okay, you have a building. Greek, a company with 31st December financial year end decided to sell one of its building on 1st of October 2018. Okay, you have decided to sell an asset on 1st of October 2018. And immediately started to market it for the sale at its fair value. Okay, IFRS 5 non-current assets held for sale and discontinued operations. A potential buyer has been found to purchase the building in its current condition. The building is ready for immediate transfer to the buyer as soon as the price negotiations are complete, and the sale is expected to take place early, within 1 year. Meaning all the conditions for it to be a non-current asset held for sale is satisfied. So you don't have any problem there. The following information is relevant to the building at 31st December 2018, and they want to know what amount should be shown in the building as at 31st December 2018. Okay. Carrying amount when you decided is 500,000. When you decided to sell is 500,000. Your fair value when you decided to sell is 525,000. Your fair value. But now at 31st December is when you are looking for. So meaning at fair value at 31st December 2018 is 505,000. Cost to sell. So the standard IFRS 5 says if you have any assets that you have held for sale, it has to be carried at cost, net book value or NRV, whichever is low. Your net book value is 500,000. Your NRV is your fair value less cost to sell. Your fair value at 31st December, because this is happening at 31st December, my dear. It's not happening on 1st of October 2018, but on 1st of October 2018, anyway you will bring it down. If you are going to take it for 1st of October 2019, if your question was 1st of October 2018, your answer would be 525,000 minus your 70,000 gives you how much? Can you use your calculator? You have to use your calculator in the exam. Your calculator, not one you see in the screen. Okay, please don't use this calculator in the exam. I don't want you to use that at all. So how much is it? 455. But your net book value is 500. So if your examiner wants on 1st of October 2018, your net book value, your net book value will be 525 minus 70, 455. You're carrying value. But your examiner doesn't want you at that point. Your examiner wants at 31st December. If it is 31st December, 505,000 minus 70,000 gives you how much? 435,000. Your answer at 31st December means you have to take this figure. If it is on 1st of October means you have to take this figure. But for us, what is relevant is this. Correct? 505 minus 70,000, which is 435,000. Answer P. Are we clear? Understood? Okay. Indicate for each of the items listed below whether the expenditure should be included in the cost of inventory. Anything that is a part of acquiring the inventory is a part of our cost of inventory or recognized in the P&L in accordance with IAS 2 inventory. Okay. An allocation of fixed production overhead. So you have incurred it to produce this inventory production overheads based on normal capacity, including the cost of P&L, including the cost. Brilliant. Abnormal amounts of wasted materials. It's not a part of our production, so it will go to P&L. Cost of storage after completion. Obviously, it cannot be taken as a part of my cost of inventory. It is P&L. Oh, come on. How long am I taking? Now you see how quickly I'm finishing it off. Okay. Teaco grows tea bushes on its tea plantation. You have tea plantation. On the tea plantation, you have tea leaves. Tea plantation, tea leaves. Obviously, plantation will be IAS 16. Tea leaves will be IAS 41, agriculture. Select the appropriate IFRS accounting standards that should be used to account for each of the components of Teaco's tea plantation by matching the correct token to the correct component. When the leaves from the bushes have reached maturity, you have the bush bearer plants. Bush bearer plants have reached maturity. They are picked and then dried. Okay, we are in Sri Lanka. I don't have to talk to you about tea plants. You have seen it through on your own. If I speak about strawberry, you know obviously. Okay, you're not seeing. Okay, how does a strawberry look? You do not know. If it's oranges or apples, we know it's a bit tough. But you know tea bushes everywhere in Sri Lanka. Ceylon tea. Okay, superb. So tokens, these are the tokens. I've got my components and I have to match. Okay, fine. Let me do the matching. If it's IAS 16, property, plant and equipment, my tea bushes are going to be what? Tea leaves at the time of picking and drying equipment. Tea bushes is going to be what? Tea bushes is going to be what? My tea bushes are my tea plantation. My tea bushes are my tea plantation. That's going to be IAS 16. My tea leaves at the time of picking, at the time of harvesting, is going to be IAS 41. And I've got drying equipments to dry. It's going to be what? Once again, IAS 16. My tea bushes, my plantation, it's going to be IAS 16. My tea leaves at the time of picking, it's going to be IAS 41. Bearer plants. Are we clear?
Become inventory if it's tea powder.
Yes. But the drying equipment is equipment, property, plant and equipment. That is IAS 16. Are we clear? Got to be very careful there. Select the correct. Okay. He has obviously taken and given it to me the screenshot. Okay, superb. Thanks. Select the correct answer to describe the nature of the loan received. The nature of the loan received and the value of the benefit received. Value of the benefit received means what is the valuation, what is the total valuation that you get in accordance with IAS 20, accounting for government grants and disclosure of government assistance. The loan received from the local government is considered to be a financial liability. The value of the loan of the government grant received is Tech received a 3 million loan from its local government to assist with expanding its business operations to build a private college. The loan has an interest rate of 1% and is repayable after 3 years. The prevailing market interest rate is 6%. So what is your benefit? Your benefit is when it's going at 6%, you're getting it as 1%. So your value, your obviously your value that you're getting is how many percent? 5%. Your 3 million over 5%. 5% interest on the loan amount over 3 years. Answer D. That's going to be your value. The value of the government grant received is 5% that you get. That is the 5% over a period of 3 million. In line with IAS 20, guys, accounting for government grants and disclosure of government assistance, a government loan below interest rate, below market interest rate, which is 6%, is a government grant. Obviously, the benefit that you get, the value that you get is going to be the difference between the market rate and the loan rate, which is 5%. Clear? Guys, are we clear? Which of the following statements is correct according to IAS 30? According to IAS 37, provisions, contingent liabilities and contingent assets. Which of the following statement is correct? Okay. Now let's read the question. What does the question say? GCO purchased land for its mining operations. GCO purchased land for its mining operations. The purchase date was 1st of August 2018. Government legislation requires that Golden Co restores the land after a period of 5 years. At 1st August 2018, the cost to restore the land based on an environmental expert's advice is 180,000. An appropriate discount rate is 6%. G has a 31st December year end. 31st December year end. Which of the following statement is correct according to IAS 37, provisions, contingent liabilities and contingent assets? Anybody? Answer. Research cost and a corresponding expense in the P&L carrying amount 9800. When are you purchasing? You're purchasing on 1st of August 2018. 5 years. 5 years. Your year end is going to be 31st December. Okay. At 1st of 2018, cost is based on environmental expense. Okay. 80, I don't know. Okay. Calculator. Okay, yeah, I have calculator. Fine. Answer. Anybody answer? Anybody answer? So it's obviously what? Decommissioning cost, dismantling cost. Dismantling cost should be added as a part of assets cost or not? Should be added as a part of assets cost. Okay, added at present value. Correct. So on 1st August 2018, GCO should recognize a provision equivalent to the present value of the restoration cost and a corresponding expense in the P&L. The carrying amount of the environmental provision at 31st December 2018 is 190,800. Correct? Not correct? No. Should recognize a provision equal to present value of the restoration cost. That is correct. And a corresponding expense in the P&L. We don't do that. No. Okay. On 1st August 2018, GCO should recognize a provision equal to the present value of the restoration cost and corresponding debit entry to land. Okay. So you are going to put a provision account and then you're going to debit land. Okay, that is correct. Because you have to take it as a part of assets cost. That is correct. Super. The carrying amount of the environmental provision at 31st December 2018 is 190,800. 190,800. Okay, we have to check that. Now, how to check that? Your total, your present value is 180,000. I'm happy with that. But your discount factor is 6%. So 180,000 into 6% into how many months? August, September, October, November, December. Into 5/12 gives you how much? 184,500 total. 184,500 is what we are getting, it seems. I don't know, please correct me if I'm finance cost 184,500. That should be added to the present value. So as at the year end, 180,000 plus.
No, that is the added amount. 4,500 is the finance cost and 180 is the present.
Okay, 4,500 is the finance cost. Okay, give me the figures correctly. 4,500. So 180 plus 4,500, is it? So this is out, no? That's out, no? This is out. It has to be C or D. On 1st August 2018, GCO should recognize a provision equal to the present value of the registration cost and a corresponding debit entry to land. That is correct. The carrying amount of environmental provision at 31st December is 180 plus 4,500, 184,500. I'm happy with answer C. Provision equal to present value of the corresponding. Okay, this is doubt, no? Expense in the P&L is out. Answer C, answer C, answer C, answer C. Everybody. Answer C. Aishwarya Varadrajan. Answer C. Correct. Indetco issued 20 million convertible loan notes on 1st of July 2013. Okay. Requirement, which statement is correct in accordance with IAS 32 financial instruments presentation. Okay, presentation. Okay. In 5 years time, on 30th June 2018, holders can choose to redeem the loan note for cash of 20 million. Okay. 20 million convertible loan note, you can choose to take 20 million cash or to convert them into a fixed number of ordinary shares or convert it. Okay. At 1st July that is today 2013, the present value of the loan note with a similar term but without a conversion option is 18.97. 20 minus 18.97 gives you how much? 1.03. Okay. They want to know the presentation. So you have present value 18.97. Your future value is 20. You have a difference, right? How much is the difference? 1.03. Okay. At 1st July 2013. Okay. Answer. Give me the answer. First year, should recognize the liability of agents and the loan notes are converted transferred to equity from the liability account. First year, equity loans are 1.03. And subsequent increase. No, it's not. It's out. Recognize over the. Yes. 20 minutes. That's out. Answer. Answer C. I'm happy with answer C. Correct. At 1st July 2013, Indetco should recognize a liability of 18.97, correct? And interest is recognized over a period of 5 years. Superb. Good job. That's correct. Answer C. I'm happy with that. Superb. Which statement is correct? 1.03. Yeah, it's 1.03. 1.03. Which statement is correct? Okay. Parent owns 35% of Kidco. 35% of Kidco, it's an associate. So P owns K. During the current financial reporting period, P sold inventory to K for 8,000 at a margin of 30%. Associate, parent is selling goods to associate. Okay, at a margin of for 8,000 at a margin of 30%. At the year end, the inventory remained unsold. Okay, you're not selling the inventory. Okay. P has recognized receivable balance of 8,000 for this sale and K has recognized a corresponding payable. You cannot recognize an intergroup transaction between the parent and subsidiary. That is wrong. Okay. So they want to know which statement is correct. The URP is 2,400. No, the URP will be 8,000 into 30% into your percentage of holding, 35%, correct? This is an associate, no? So 8,000 into 30% is 2,400 into 35% gives you 840. Okay, that has to be the URP. So I am confident 1 and 3 are not the answer. That's all. Correct, no? The unrealized profit element is 2,400. The unrealized profit element is 2,400. And the receivable and payable balances are cancelled in the consolidated financial statement. We don't cancel it. Correct, that's wrong. The URP is 840. Receivable payable balance are cancelled in the consolidated financial statement. No, we don't cancel it. So it has to be D. The URP balance is 840. Receivable and payable balances are not cancelled because you are not going to cancel in the consolidated financial statements. Answer D. Answer D. Because no cancellation required. Oh. How's it going? All good? Let's finish off section A and take a break. Okay? We have only 5 more questions to go. Right. Fitco owns a 40% shareholding in .co. Fitco owns 40% shareholding in .co. Okay. Associate. Which it gives significant influence during the year. Fitco sold goods to DCO. At the year end, .co still holds some of these goods. Okay. Select the correct account, correct tokens to reflect the consolidation adjustment required in relation to the URP in inventory. Who is the seller? Parent is the seller. If parent is the seller, eliminate it from parent's cost of sales. That is obviously your retained earnings is coming down. Parent's retained earnings, cost of sales, and credit investment in associate. So debit cost of sales and credit investment in associate. Are we clear? Increasing my cost. BCO has a year end of 31st December 2016. It entered into the following foreign currency transactions in the current year. Transaction 1. Okay. Requirement. Indicate which of the options are correct in accordance with IAS 21 foreign currency transactions. Okay. First of all, transaction 1. On 25th October 2016, BCO bought inventory denominated in a foreign currency. At the year end, the inventory has been sold, however, supply has not been paid. Trade payable, monetary or non-monetary? Monetary. Trade payable is a non-monetary item. The trade payable is translated or not translated? Translated or not retranslated? Retranslated as at the year end. On 1st July 2016, BCO purchased equipment to be used in its production. Equipment, monetary or non-monetary? Non-monetary. The equipment is measured using cost model and depreciated over the useful life of 5 years. Translated or not retranslated? Not retranslated. Which of the following options is correct in accordance with IAS 21 foreign currency transactions? FCO purchased a building paying for it in a foreign currency. The building was classified as investment property and FCO adopts IAS 40 fair value model for such properties. FCO purchased a building paying in a foreign currency. The building was classified as investment property and adopts IAS 40 fair value model for such properties. Since the building was purchased, its fair value has increased and exchange gain has arisen. Exchange gain has gone up and then you have fair value increase as well. Which of the following option is correct? The increase in fair value and exchange gain should be recognized in P&L. Correct or not correct? You have a fair value gain, you have an exchange rate gain. Investment property. Ashfaq, correct. Answer correct. A. Because it's an investment property, fair value taken to P&L. Superb. 14 and 15, we have only 2. Okay, superb. Let's go. TCO manufacturers, okay, requirement. Which of the following requirements reflects the correct accounting treatment for the brand in line with IAS 38? Oh, you would see this, okay? They'll just simply say, no, amortize the brand for 5 years, 10 years, 15 years. Stupid, that's wrong. Just ignore, okay? I never taught you anything like that. Okay, which of the following requirements reflects the correct accounting treatment for the brand? Take a minute. Tell me the answer. Give me the answer. Last option A. Thirstco manufactures Q branded soft drinks. The brand was purchased from a competitor during the current year. Thirstco's management believes that Q's brand will contribute to net cash flows of the entity indefinitely. Which of the following requirements reflects the correct accounting treatment? Okay, they are not talking about 10 years, that's out. Amortize the brand over the maximum useful life of 10 years and test for impairment if indicators exist, that's out. Do not amortize the brand, but review the useful life when there is an indicator to check if there's evidence that it has changed. Test for impairment only if indicators exist. No, if you're not amortizing, you have to do an annual impairment test. Amortize the brand over a maximum useful life of 10 years is out. Do not amortize the brand, but review the useful life in each period to check if there is evidence it has changed. Test for impairment annually. That's what IAS 38 says. Test it for annually and whenever the indicators exist. Answer D. Are we clear? Why not C? No, because it's going to be investment property. Investment property, any gain or any gain has to go to the P&L, and any exchange gain as a part of investment property will go to the P&L. Complete the sentence below. Complete the sentence below by filling in the blank. In accordance with IAS 33 earnings per share, the basic EPS in 2017 presented as a comparative in 2018 financial statements is what? The following information relates to profit go at 31st December 2018. So you have equity shares of $2 each, 200,000 in the current year, and last year 50,000. Profit for the year is 160,000 and 95,000. During the year there was a bonus issue of equity shares. Okay, no other shares were issued in 2017 and 18. Okay, they have gone only for a bonus issue of shares. They want to know what is going to be your comparatives. Comparatives means they want to know last year. When it comes to a bonus issue, we assume that bonus was always there. So if I'm going to rework on my shares, that means I will assume that this 200,000 which is there in 2018 was also there last year. But 200,000 last year is the value. So number of shares last year would have been 200,000 over 200,000 shares. So 100,000 shares always existed is my assumption. So last year my profit was 95,000 over my shares were consistent, did not change, which is 100,000. Correct? So 95,000 over 100,000 gives me 0.95 or 95 cents. 95 cents. Answer 95 cents. Because I will always assume that this was there. Bonus issue shares. Superb. Okay, yeah, there you go. We are done with section A entirely. Section A entirely done.